Welcome to The Explainer, where we break down big topics. Today, we're tackling the complex world of international trade finance. Think of it as the hidden engine that powers something like 80% of all global trade. Yeah, it's not the ships or the planes, it's the financial system running behind the scenes, and we're going to unlock exactly how it works.
All right, let's start with a situation you can probably imagine. Say you've made a great product, right? And you found a buyer, but they're overseas. You're ready to go, but then you hit this classic roadblock. You won't ship until you're paid, and they won't pay until you ship. So, now what? You're stuck in this total stalemate of trust.
And this is exactly where trade finance comes into play. It's really not just about getting a loan. It's so much bigger than that. It's a whole system, a kind of financial architecture that's been built specifically to solve these exact problems, the ones that pop up when you're trying to do business across borders.
Okay, so let's dive into this. To really get a handle on trade finance, we've got to look at the 4 core problems it's built to solve. You can think of them as these major hurdles that every single international deal has to overcome. So what are they? First up, there's payment risk. Pretty straightforward, right? That's the exporter's fear. Will I actually get paid for this? Then you've got the flip side, performance risk. This is the importer's worry. Will I get the goods I actually ordered? Third, you've got this timing mismatch. The exporter needs cash right now, but the buyer wants, say, 90 days to pay. That's a huge cash flow gap. And finally, there's the pressure on your balance sheet. For both sides, really. Every dollar tied up in an unpaid invoice is a dollar you can't invest back into your business. So, with all these hurdles, how do businesses actually get deals done? Well, it's not with a single solution. It's more like they have this amazing toolbox full of specialized instruments. So, let's open up that toolbox and see what we've got.
Okay, first up is a tool called documentary collections. This one is great for situations where there's already some trust between the buyer and seller, but you still want a bit of a safety net. What it does really cleverly is it puts banks right in the middle of the deal to act as, well, as intermediaries.
And here's how it works. It's pretty brilliant. The exporter ships the goods, but, and this is the key part, their bank holds on to the shipping documents. Think of these documents as the keys to the cargo. The importer can't actually claim their stuff from the port without them, and they can only get those documents from their bank after they pay up. So, it's simple. No payment, no documents. No documents, no goods. Problem solved.
Okay, but what if the main risk isn't about getting paid for goods, but about someone actually doing what they promised? Like in a massive construction project overseas. The client needs some kind of assurance that the contractor is going to see the job through. That's where a bank guarantee comes in. It's basically the bank promising to cover the loss if one party doesn't hold up their end of the bargain.
All right, let's switch gears. What if the problem isn't trust at all, it's just time? That timing mismatch we talked about. You've shipped your product, you've sent the invoice, but the payment terms are 90 days out. The thing is, you need cash now to pay your employees and buy more materials. This is a super common problem, and a popular solution is called factoring. It's simple. You basically sell your unpaid invoices to a finance company at a small discount, and they give you the cash right away.
Now, when you get into factoring, there's a really important distinction. You've got 2 main types. The first is with recourse. That means if your buyer ultimately fails to pay, that risk comes right back to you. You're still on the hook for the money. The other option is without recourse. Here, the factoring company, the factor, absorbs that credit risk completely. It's a bit more expensive for sure, but hey, it gives you total peace of mind.
Let's talk about a more modern and, honestly, a really powerful tool called supply chain finance, or SCF. This is especially useful in today's world, where you often have these huge, creditworthy buyers working with lots of smaller suppliers. It's a super elegant solution that uses the big company's financial strength to benefit everyone down the chain.
Here's how it works, and it's a true win-win. So, a big buyer, let's say a major retailer, approves an invoice from one of their small suppliers. A finance provider sees that approval and immediately pays the supplier, minus a tiny discount. So what happens? The small supplier gets their cash right away, which is amazing for them, and the big buyer gets to stick to their original, longer payment schedule. The whole thing works because the financing is based on the buyer's excellent credit rating, making it super low risk for the bank.
But what about the really huge long-term deals? I'm talking about things like selling a fleet of jets or building a massive piece of infrastructure in a country that might be considered, well, politically risky. For deals like that, private banks often get pretty nervous. The risk is just too big for them to take on all by themselves.
And this is where governments step in to help.
They have these things called export credit agencies, or ECAs. Think of them as a government-backed insurance policy for exports. They'll provide guarantees or even direct loans for these huge risky projects that are super important for the national economy. Basically, the ECA takes on the political or long-term risk that private banks won't touch, which then gives those banks the confidence they need to finance the deal. Okay, so we've looked at all these different tools in the toolbox. Documentary collections, factoring, SCF, ECA financing. It's a lot. So the big question is, how do you pick the right one? The key thing to remember is that it's not about finding the single best tool. It's about matching the right tool to your specific situation. It really comes down to your specific needs. For example, if trust is low and you're dealing with a high-risk country, you're going to want maximum security. That's when you'd use something heavy-duty like a letter of credit or a bank guarantee. But if your main issue is just getting cash in the door quickly, then you'd be looking at something like factoring. And like we just talked about, if you have a big, strong buyer working with smaller suppliers, supply chain finance is probably the most efficient, elegant way to go. It's all about the context. All right, so we've gone through the toolbox, but let's zoom out for a second. Why does all of this matter on a global scale? Well, it's because even with all these incredible tools, there's a huge, and I mean huge, gap in the system.
What are we talking about? $2.5 trillion. That's the number from the Asian Development Bank. That is the estimated size of the global trade finance gap. Just think about that. That's trillions of dollars in deals, in products, in economic growth that just isn't happening, all because the right financing couldn't be found.
And you know who gets hit the hardest by this gap? It's not the giant corporations. It's the small and medium-sized businesses, the very companies that are supposed to be the engines of our economies. They're the ones facing higher rejection rates for financing, and they just don't have the same bargaining power.
So this really brings us to the most important point of all. These instruments we've been talking about, they're not just some obscure financial topics. For so many businesses out there, understanding these tools, well, it's the difference between a transaction happening or not happening. It can literally be the key that unlocks the door to a global market. So, we'll leave you with a question to think about. Why is a tool like supply chain finance so incredibly powerful, especially when you have a strong buyer working with a lot of smaller suppliers? If you can answer that, you really get to the heart of what modern finance can do. It's not just about moving money around. It's about building systems where one company's strength can lift up an entire ecosystem. It's a fascinating idea to chew on.